What is going on, guys and girls? Good morning, good evening, good afternoon. Welcome back to the channel. And in today's video, we're going to be covering some technical analysis, do's and don'ts, and fundamentally, we're going to be covering the mechanical advantage. And this is exactly why disciplined trading beats emotions every single time. Something is occurring right now in the markets, and that is that every crypto moon boy bag holding alt season wannabe is getting absolutely rinsed because they are emotionally trading, because they haven't understood fundamentally what the mechanical advantage is and how to use it. So in this video, I'm going to break down exactly what it means to have a mechanical advantage, how that would filter into your trading, and what kind of decision making that would influence by having a mechanical advantage. What that mechanical advantage looks like in a real life scenario. We're going to have a look at some charts today as well. And then I'm also going to give you some tips and tricks on how you can implement this into your own trading so that you stop taking too many losses, emotionally trading, over trading, under trading, trigger happy, over risking, under risking, a shit show. If your trading is a shit show and you want to fix it, this video is for you. So let's get straight into it. So what do we have? We have the mechanical advantage. And as I said, this is why disciplined trading beats emotions. The disciplined traders, the mechanical traders, take money off of the emotional traders every single time, without fail. There are no exceptions to this rule. So the markets today, crypto, as of right this second recording this video, is choppy. We've been range bound now for a couple of weeks and nobody wants to admit it. And being range bound is fine, but in range bound environments, you alter your trading. You trade slightly differently to the way you would in a trending environment, or at least I do anyway. So gold and silver is also following a similar pattern. We are in a sideways consolidation in the commodities markets right now. Gold and silver are not presenting A+ setups like they were in the previous few months. Gold up only, higher time frame, bullish market structure, price discovery every single day, gone. That's not there anymore. That's okay. We just adjust. And if you have a mechanical system, then you can adjust to those changes. We also have an increase in volatility. We somehow have normalized multi-hundred pip moves across the largest asset classes in the world every single day. The reason that prop firms are currently banning trading gold is for one of two reasons. Either people are absolutely torching their accounts and people are leaving, meaning they're losing business, which they would want to stop, or they're having too many people passing prop firm challenges because they're trading gold and silver, which is moving multi-hundred points in a single trading session. And therefore, prop firms naturally profit off of traders losing money, not from providing lots of payouts. One of those two scenarios is the reason that prop firms have now started preventing you from trading commodities. As of last week, Apex has shut down gold and silver. Topstep is reducing all kinds of other instruments. They're now looking into hedging, etc., etc., etc. They're cracking down on it because we have an increase in volatility. And higher volatility means more risk. So you have to keep that in mind because we're in a very risky environment right now. And lastly, emotional decisions, equaling account destruction. If you are an emotional trader, you are going to light your trading account on fire so quickly because you're not going to risk manage properly and you're going to make stupid decisions. So what most traders do, trade on a feeling. I think this is going to go up. I can feel the moves coming. What is that? They increase risk when they're uncertain. I'll just double down. Oh, I lost it on my last trade. I'll make it back on this one. They make decisions based on the news. So-and-so reckons that this is happening with XRP. Jesus Christ. How many times have you heard that? The XRP army. Where are they now? Broke is where they are. They let emotions drive their position sizing. This is going to be the winner. I lost out on the last one. I'm all in on this one. And they don't have a clearly defined exit strategy. Take profits. Where are you taking profit? You're not Hail Marying back to all-time highs unless you'd like to sit in that position for 3 to 6 months and pay fees on it. This is where most people seem to sit and just normalize this as good behavior. This is not good behavior. This is reckless behavior. Mechanical trading. Predefined rules for entries and exits. Clearly defined risk management protocols and triggers. If X occurs, I will do Y. Once I'm in the position, I will do this. If I see this occurring, I will switch to this management style, etc., etc., etc. They have systematic position sizing. If I'm swing trading, 2% risk. If I'm day trading, 1% risk. If I'm scalping, 0.5% risk, for example. They have emotionless execution. Mechanical trading is emotionless execution. You are a Navy SEAL following a military exercise. That is it. If this occurs, I will do this. Zero emotion, zero hesitation. It is an if-then statement on everything. and you have rule-based exits. If this occurs, my thesis is no longer valid. I'd like to exit the position. I'm taking my profits here because XXXXX. This is rules. When you have rules and when you have a plan and when you have a mechanical blueprint for your trading, all you have to do is read the plan and follow the blueprint. Wow, I can't talk tonight. Read the plan and follow the blueprint. Now, adapting to conditions like right now. Markets are choppy. Markets are choppy. I'm going to say that again. Markets are choppy. So what do? Well, you reduce your position sizing. You tighten up your stop losses. You increase your selectivity, your filter on these trades. How picky are you being with these trades? And you stick to the plan. What does it say in your plan? Well, I can tell you exactly what it says in my plan. We can have a look at the Bitcoin chart right now. This is the BTC 4-hour chart. We had this flush. We came up here. We rejected 71.5 right here. Then something happened. We formed a higher low. Amazing. Although this is currently no man's land in here, so I'm not interested in anything in there. So what I want to see is, are we going to come up here, break above here, and make a higher high above 71,500? And if we are, then I'm interested. If not, and we reject it, then we're stuck in a range. What happens? We come up, we reject it, bearish engulfing close, we're now stuck in a range. I would be expecting us to decelerate here. We didn't. We blew straight through it, broke and retested it, and came back all the way down to 65,750. So have a guess where the range is, between 65,750 and 71,500. Meaning this little box here, for me, is a no trade zone. Why? Because markets are choppy. So I'm reducing my position sizing. I'm tightening up my stop losses, even though I'm not taking anything. I'm increasing my selectivity. I want to see one of these two scenarios occur. Break and retest of this or a break and retest of that. In here is where everybody is getting absolutely rinsed and losing money because they think that we're going to V-shape recovery this and they haven't understood fundamentally what it means to be in a range, basic market structure, etc. And they don't have a plan. So when this occurs, it's hit and hope. It's guess. It's long and I'll just fingers crossed it works out. That's not a plan. That's guessing. That's emotion. And that's how you lose money. So you stick to the plan, you follow your plan, and right now my plan is telling me that this is choppy, this is range bound, and unless we do one of these two things, that one being one of them and this one being the other one, then I'm doing nothing at all. I'm reducing my position sizing, tightening up my stop losses, I'm increasing my selectivity, and I'm sticking to the plan. And that's it. So, the trading plan. What does the trading plan actually have in it? Well, it's got market analysis, what's happening on the charts, what's the environment. As I said, reading and understanding price action. For me, that's market structure, higher highs and higher lows. That's fib retracements. That's overbought and oversold conditions. That is 4-hour breakouts, variety of different strategies. That is setup identification. Does this trade meet my criteria? Well, right now for me, no, because I don't trade ranges because they're choppy and messy and I end up donating profits. So no. Does it meet my criteria right this second? No. Risk assessment. What can I afford to lose? Am I comfortable risking 10% of my account on this choppy price action? No. Am I comfortable risking 1% of it? No, either. But that's the same question you have to ask yourself. How much can I afford to lose? Because right now, we don't have A+ setups. So you shouldn't be running A+ risk. We've got like D- or C- setups. So you should be running C- risk, taking it easy, being careful. Position sizing, never more than X percentage. I highly recommend that is capped at 2%. You're free to risk manage as you please, but I had it drummed into me from a very young age. I've been trading nearly 9 years now. You do not risk more than 1 to 2% of your account per position. And 2% came after quite a lot of practice. At the start, it was 1. I highly recommend anybody watching this video, cap your risk. 1 to 2% of your account per position. And to go a layer deeper than that, how many positions can you be in at once? Because if you're risking 2% per trade and you've got 10 trades open, what happens if they all go against you? So yes, you risk manage accordingly. You never risk more than X percentage. But in a mechanical trading plan, you'd also have a clearly defined number of trades that you can be in. Example, I don't take more than 2 positions. I don't take more than 1 position unless I can remove my risk on the first position, etc., etc., etc. An exit strategy. Where do I want to get out of this trade? Where am I wrong? Where's my stop loss? Predefined before you enter the position. That's what a trading plan looks like. That's what the professional traders do with their risk management. You remove your human error. You're the problem. You're in the way. Human beings are fundamentally flawed. They make stupid decisions. So you remove the human error. This removes second guessing. It allows you to consistently execute. It removes your emotional decision making. It allows you to repeat the same results because you're out of the way. And it allows you to scale that approach as you grow, build, and develop your account. And this is exactly what I've done with everybody inside QT, especially the one-on-one guys. Move you out of the way, move them out of the way, and then your path to profit becomes shortened. Crypto analysis. We've already covered it. It's range bound between 65, 750 and 71, 500. And right now, for me, that's a no trade zone. There's no clear directional bias for me right now. I don't know where we're going to go. We might go up, we might go down. But right now, we haven't decided which of those two we're doing. So for me, no clear bias, right? There's a noise to signal ratio, meaning too much of this. It's choppy, it's messy. Can't make out what price action is going to do. So it's best for me to do nothing at all. This is the perfect environment for overtrading, because if you said, I'm buying the dip, you'd currently have bought the dip, probably rode a 5 to 10% move to the upside, and now you're underwater or back to break even. So you could have been in and out of about 10 trades by now, and you'd probably still be at the same entry price, meaning that these are optimal conditions to overtrade, which is not where we want to be. The mechanical approach is to wait for clarity, an if-then statement. If this occurs, I will do this. Precious metals. Let's have a look. Let's pull up the gold chart. You guys and girls know that I love to trade gold, so let's have a look at the 4-hour chart on gold. You can see some of my 4-hour impulse entries down here. So what do we have? Bullish run up, clean higher highs, higher lows, higher highs, higher lows, break and retest everywhere, super clean market structure. And then we have this, the almighty gold flush from 55.90-ish all the way down to 4,400, a almost $1,200 move on gold. Big moves. So what's everyone doing? Buying the dip on gold. Why? Because gold's going back up. It's going to V-shape recovery. Okay. But then it actually formed a lower high and then it sold off and rejected around 5,100. Okay. So it didn't V-shape recover, did it? Then it came back down to here and formed a higher low. So now it just looks confusing. So what I'd be looking for is a breakout above the area that we just rejected a few days prior, which is 5,100. Okay. So to me, this is neither bullish nor bearish. This is choppy. Now this is messy. So my mechanical approach to this is patience. Wait. I don't have enough to be confident in this anymore. It doesn't look like it did before. Something's changed. A+ setups off the cards. Now it's C minor, D minor maybe, D+ setups. So what do I want to see? Clearly defined rules. Wait for a breakout confirmation. This one right here. Are we going to break 5,100? If we do, I'm long. I'm getting long. That's my trigger. Until that trigger is hit, I'm doing nothing. So then we came up, didn't quite reject it here, but you can see price action flirted with it here. Then we came all the way up here. You could argue there's probably some sort of lower time frame trend line in there, and look at that. Last Thursday night, New York session, bang. What's this? This is a lower low. Messy. Lower high. Messy. Middle of nowhere. This is just absolute chop that I want nothing to do with trading. So you wait, you be patient. You let the market show you its hand before you do anything. This is mechanical trading. When to step back. Recognizing when not to trade is very important, like right now, like I just showed you. Low probability setups, market structure is not clear, it's choppy, it's range bound, your emotional state is now compromised. If it's not staring you in the face, if you have to look for reasons to take a position, you're probably overtrading. My system says don't trade. Just be patient, wait. Position sizing rules. Never risk more than 2% per trade. If you're a beginner and you're watching this video, 1%. Reduce your size in choppy markets right now. Either half it or drop it down to 0 and don't trade. Scaling out of your winners systematically. I like to do this because taking profits is good for the soul. And I like to take incremental profits as the trade moves in my favor. That's just my management style. And I have that clearly defined in the trade. So when I'm in it, I already know how I'm going to manage it. I already know what my take profit's going to look like. You cut the losses quickly and you let the winners run. You either want to make a little bit or make a lot or lose a little bit. You never want to lose a lot. You never ever want to be in a position where you lose a lot. You either lose a little bit, make a little bit, or make a lot. One of those three. So you need to cut your losses. Have a clearly defined area where you're wrong. And if you're wrong, SL. Or if you've got an invalidation before it gets to your stop loss, manually close. Think like a machine. Think like a mechanical machine. You need to focus on your process over prediction. You're the potential problem. So move you out of the way and follow the process. Probability over certainty. I know that in a long enough data sample size, this will occur. Cool. So I might actually take a breakout trade that hits my stop loss. That's okay. I know that over time, breakout strategies are a very, very profitable strategy. I operate on my systems instead of following my emotions. I think this is going to do this. Bullshit. I'm not doing anything until we do this, and this. Cool. And you want to go for consistency. If you can consistently execute a mechanical trading approach day in, day out, you will become profitable. You will become profitable if you execute consistently. We're not interested in making a 200x on a meme coin trade. Those days are gone. Consistently executing mechanical trading day in, day out. This gives you consistent performance. It reduces your drawdown. It allows you to sleep at night, so you're not constantly glued to the charts all the time. And it allows you to scale your trading business. If you treat your trading business like a side business, that's all it will ever be. If you treat it like a full-time business, it might just become one. You will become long-term profitable if you start to implement mechanical, no-decision trading. If you're ready to go mechanical and you would like to learn the complete mechanical trading system inside Quantum Traders, where we make mechanical decision frameworks, implement proper risk management protocols, risk manage accordingly, have clearly defined take profits and entries and stop losses before we even enter the position, multiple different market analysis methods, multiple different instruments, commodities, crypto, FX, everything. One-to-one coaching, VIP experiences, if you're in the high-level program that we offer. I'm going to put some links in the description. I've interviewed hundreds of traders, and the most common thing that people get wrong is that they do not have a system and they are emotionally trading. If you can fix that, and if you can build yourself a mechanical system, your path to profit gets so much shorter. And everybody out there doesn't want to tell you this because it requires them to give you the keys to the castle. But giving you the keys to the castle empowers you to build your own plan, refine your style, reach profitability, extract money from the financial markets, and build a good life. And if that involves quitting your job or building a lifestyle business, then I hope and wish that happens to you. Because it happened to me, and it's happened to a lot of people that I've worked with over the years, and that's how I know it works. So I'm going to put some links in the description. If you're interested, if you want to find out a little bit more about mechanical trading, I think I've got a 10-minute video breaking down exactly how we did this for Ellis and how we were able to help him go from making $200,000 a year to $170,000 in a single trade, quitting his job, building a lifestyle business, and escaping the matrix. That video is in this description. So, last thing, remember, the market does not give a fuck about your emotions. Your trading plan should reflect that. Follow more for mechanical trading insights. And remember, the market doesn't give a fuck about your emotions. And I will see you all in the next video. Take care.